Good evening, ladies and gentlemen. Thank you all for taking time off your schedules to join us. For tonight's webinar, we have a two-part presentation. So first up will be Mr. Colin Low, who is part of the IFAS macro research team, followed by Mr. Christopher Wong from Fidelity International. Tonight, Colin will present about emerging markets, the reasons behind the recent headwinds, as well as the reasons for the optimism we have in this area. And following that, we have the privilege of having Christopher, who will also share with us how investors can tap into Fidelity's expertise to capture the opportunity in emerging markets. So with that, I'll just hand over the time to Colin.
Hi, good evening, everybody. So I'm Colin, a senior analyst from the macro research team. So today it's my pleasure here to talk about emerging market equities and how we maintain our optimistic outlook despite some near-term malaise. So diving right in, let us look at the EM equity performance overview over the past year. So from the chart right here, you can see that there's a blistering rally that started since the early November, since during the start of the US election. So that is a huge dramatic 30 over percentage rally for EM equities since the start of November. So that rally was halted in the middle of February. So what happened really since then was emergence of a couple of headwinds in the first quarter, especially that stopped this rally. So there are some headwinds that we noticed that really stands out to us. So I think the first one is most definitely the rising US rates. So that led to Asia tech weakness as well. So the second part, which is the China tech regulation intensifying. And lastly is the counter rally of the dollar, which started at the start of the year. So if we were to really look at the different performance through the different Asian equity markets, you'll find quite bifurcated performance between the top as well as the bottom emerging markets. So on those charts seen on the screen right here, you'll find that, for example, Taiwan leads the pack of EMs by a whooping 20%, while Brazil, which is the laggard here, it has fallen by 5% since from the start of the year to 27th of April. So the chart on the right shows how both leader and laggard itself have maintained their top and bottom position pretty much throughout this year. So I think that it gives you a sense of how within the emerging market there can be bifurcation of performance, and some equity markets can perform better than the other, therefore leading the broad or dragging the broad equity markets. So maybe diving right into the first headwind, I think many investors are still concerned on Asia tech. So I think to answer the question, in short, to answer the question whether Asia tech weakness is a cause for concern, we believe no. But before I go into details, I first want to explain why. And I think if you look over the past quarter, you'll find that the weakness emanated from two different areas. So the first one comes from rising US rates, which eventually weaken Asia tech, or rather global tech, and therefore Asia tech get hit as well. And the second weakness coming from the Asia tech is the intensification of China's tech regulation. So the combined effect of both has actually hurt EM equities, the broad EM equities, by quite a bit. And the reason so is because of its greater vulnerability due to its growing exposure to growth. So as shown from the chart right here, growth as redefined by your tech and your consumer discretionary has almost doubled in its allocation over the past 11 years. So from just slightly below 20% to now about 40%. So that itself has kind of made the vulnerability for EM equities towards all this tech weakness slightly higher. But overall, looking at a longer term picture, I do not believe it is necessarily a negative for emerging market equities, because I think having a good mix of exposure, especially towards growth, enables the EM equities to get exposed to some of these very long-term secular headwinds. And those are some of the headwinds coming from more tech adoption and greater tech integration into certain economies. And those are the ones that could be driving EM equities over a longer term period. So moving our sights to China tech, we largely believe that the bad news has been priced in. So we do not see the intensification of China's tech regulation as a material headwind yet. So how we really dissect this situation is over the past over the past few months, we find muted reactions to incremental news flow regarding China tech regulation. That tells us, or that is a key telling sign that some of the performance has been, or some of the bad news has been priced in. So again, when we look objectively at the situation at hand, we believe China's tech companies are systematically crucial to its growth, especially over the past 5 years. Really, China tech companies have contributed so much to China's economy, and we believe policymakers themselves is more likely to widen the regulatory oversight rather than to risk China's growth trajectory, and especially important coming out from this COVID-induced recession. So again, another key factor here lies more on a relative basis to the US. We truly believe that China is unlikely to overstep the regulatory oversight given the ongoing US tech competition, and given the China's 5-year plan and the target of 2025 having developed its own tech sector, we do not think that China is likely to overstep the oversight and compromise their own tech sector. If we were to draw back into the fundamentals for China tech, we find that the fundamentals largely still remain robust. We see strong EPS growth for the year as well as strong revision. So that itself is also underpinned by very positive China macro. So if you look at the chart on the right, which shows the EM tech, EM consumer discretionary, China tech, China discretionary, as well as the MSCI overseas China, which measures China ADR, we find that bad news has been largely priced in, as I've mentioned, and we see green shoots of recovery already coming in for this sector. So I think the next concern for many investors, which is a valid concern, is whether the stronger greenback or stronger US dollar is a worrying factor for many investors. And I think the short answer is yes, but not necessarily so. We do believe a higher dollar is a main key headwind holding the emerging markets assets back. So to roll back a couple of months, we find that the US dollar actually countered rally in the early parts of January. So the chart on the left shows the DXY index, which is the US dollar index, versus the JPM EM currency index. So whenever the dollar strengthens, the EM currency actually weakens. So we saw that happening during the start of the year, where the DXY index counter rallied to about the end of a couple of weeks ago, when the strength of the dollar actually fell back again. So there is a significant impact whenever the dollar strengthens, because on the chart on the right, you'll see the 1-year rolling correlation. So whenever the dollar goes up, EM equity as well as EM FX comes down, and EM sovereign spreads goes up. So what this simply means is, whenever dollar goes up, EM equity and EM currency weakens, while the sovereign spreads increase, indicating higher pricing in of credit risk. So the impact of the dollar itself is not just EM equity, but broadly on equity, FX, as well as EM credits. So the key reason why we are staying positive on EM equities despite the recent counter rally is because we do hold a bearish view on the US dollar. We believe the downtrend should reassert itself again and ultimately be supportive for emerging markets. So there are 3 factors that really stands out here that weakens the likelihood of a sustained dollar strength. So I think the first reason here is a potential peak in the yield differential between the US as well as the EU as well as Europe. So if you look at the chart on the right, you'll find the blue line itself, which is the differential in yield, has from what I believe has already peaked. So that itself is important because it's setting up for potentially a stronger euro versus the dollar. And given that the euro makes up about 60% of the DXY index, a stronger euro will likely mean a weaker dollar. So this is a very powerful factor that tells us that USD strength might not be able to sustain in the near term. And the second key reason here is, which I will show over the next couple of slides, is that the net speculative dollar position has come back to neutral. So this means that there's a lesser room for USD short covering, which in fact can push the dollar even higher. So we see that happen a couple weeks ago, and with the closing of this short covering or short positioning, we find lesser room for that kind of squeeze higher for the dollar. And third and final reason is coming from the growth differential factor. We believe that emerging markets should close the growth differential versus the US in the later part of this year when the vaccination as well as the reopening catches up. And that itself could be bullish for EMFX, and therefore we might see that the dollar weakens against EMFX. Yeah, so like I mentioned earlier, the USD move itself in early parts of the year was exacerbated by the short covering. So the chart on the right shows the DXY index against the net non-commercial US dollar position. So this measures the speculative position for the US dollar. So we can see that it trades in very close tandem with the dollar. So at the earlier part of the year, you can see quite clearly that the net non-commercial position went to negative, and that means investors are generally on a net short for the US dollar. So rather a couple of weeks ago, you see a sharp increase in this line, where I think that is indicative that a lot of people are rapidly closing up their short position and therefore pushing the dollar higher. So now with the short position going back to neutral, we see lesser room for that kind of a squeeze, and therefore a lesser impetus for the DXY index to move even higher. So again, moving to the chart on the left-hand side, we find that the macro environment also favors a weaker dollar. So here is a simplified version of the dollar smile. So what this means is the movement of the dollar tends to follow this smile pattern, whereby whenever the US growth outperforms rest of the world, the dollar appreciates because of the pro-cyclical draw for the US markets. So the same goes for when when global growth itself weakens and we see some form of global recession, and US dollar is seen as a safe haven, and therefore the dollar strengthens as well. But the case is true also for when the dollar depreciates. So whenever we see that happens, it usually means that there's some synchronized global growth, and global growth is faster than the US dollar, and therefore money is flowing out of the US markets to the rest of the world, and we see the dollar depreciating. So moving ahead, looking at the outlook for the second half of this year at least, we believe that the US growth outperformance will slowly be closed by growth of the rest of the world. And a large part of it is because we believe US growth is starting to peak down. So once that happens, I think the rest of the growth gap will close, and flows will go back to the rest of the world, and therefore the US dollar will likely to depreciate much more. So as indicated by the chart there, that point there is where we believe first quarter is at. So moving ahead, we see that point moving down, and therefore a weaker dollar should again reassert itself. Yeah, but I think a key main reason for our dollar bearish view is that over the middle to a longer term, we do believe that a higher deficit for the US, which has historically weighed on the US dollar itself, should again pull the dollar back down. So I think this time should be no different as what we've seen in the past in 2009 and also in early 2001. So the chart right here shows quite convincingly or quite clearly the trend of how a combined deficit will pull the dollar down. And looking ahead, at least for this quarter, we are going to. It is forecast that the combined deficit will sink to its lowest level ever, and that itself generally is bearish for the dollar, at least leading the DXY index by about 17 months out. So as you can see from the chart here, the longer term and so as a intermediate term picture for dollar is based on the chart itself is rather bearish. So with the headwinds addressed for emerging markets, we look towards the the fundamentals of the emerging markets and see whether fundamentals have actually weakened despite the emergence of those headwinds. And in fact, the good news is for both the macro fundamental as well as the corporate fundamentals, we find that the recovery are still firmly in place. So starting right off with the macro recovery, we do see strong recovery momentum despite the different setbacks from the virus resurgence. So here shows a snapshot of the PMIs across most of the major EMs. So you find that the PMIs actually highlight accelerating growth momentum. And unlike China, we find that most growth momentum for most of the emerging markets still remains strong. And in fact, some of them are actually still picking up. So in that itself is one key reason why we believe growth momentum should stay strong and perhaps even go even stronger in the second half of the year. So looking at the snapshot of a headline GDP, I think forecast expects for this year as well as next year for EM GDP to rebound really strongly. So forecasts for the next 2 years are above 5%, which is above historical trend. Yeah, historical trend as we measure is about 5% over the past 20 to 25 years. So the growth outlook for EM, we do believe our base case scenario for growth outlook for EM is actually a robust growth year round. We see growth this year being well supported by a couple of key reasons. So number one is the manufacturing upcycle, and number two is the rising commodity prices. And both number one and number two are a function of global cyclical recovery. And alongside that, we believe the easy monetary conditions for this year and for what we saw last year will most likely stick for much of this year. And despite some talks of Fed tapering, which we believe will be at the end of the year, our thesis remains solid, and we believe that we will likely see easy monetary conditions for most of the year, which should be positive EM equities. And last but certainly not least, the recent US fiscal impulse itself, we believe that it will bleed through from the US into the emerging markets, and we should be able to see some lag effect in the second half of the year. Therefore, the combination of all these factors shows supportive growth for EM equities for this year. So if we take a look at GDP revision itself, we find that EM's GDP revision for this year has been rather steady. So we on the chart here, on the left-hand side, you find that DM's revision for the year, we believe is much front-loaded, whereas the EM's revision, we believe, might come more on the second part of the year. But as you can see, or as I've explained our outlook on growth, we do believe that there is more scope for a GDP revision, and therefore, across this year, we're likely to see the EM-DM growth gap, the difference between the GDP growth for EM and DM, to close as we traverse the year. So I think this growth gap is important because it's a driver for EM equities outperformance, and we do believe that it is expected to widen the later part of that year. And a key reason to that is, like I mentioned earlier, DM growth, we believe, is likely to peak before the emerging markets, and leading that peaking is US growth, which should peak out the next couple of months. So that itself is a major contributor to the widening of the growth gap. And I think a couple of questions that I received lately is concerning the monetary tightening for emerging market and whether that itself will be a risk. So to answer that question, what I see is the monetary tightening right now, the risk of it remains rather mild, and we believe that those that are higher at risk comprise the minority of major EM equity indices, which against mitigates the impact of that to the overall EM equity. So I think that itself, there are just a couple of countries that are being exposed to this risk, and those countries are mainly the deficit countries that's running either your fiscal or your current account deficit, and those countries that have witnessed severe currency depreciation the year before. And this tends to be the same group of countries. For example, Brazil is one major culprit for that, and also to some extent Russia as well. So I think if you look at the table right here, you'll find that looking across the major emerging markets, we find that the inflation rate for most of them are still within range, and in fact, for some of them are still below the target, which is sending out a very comfortable signal to us that majority of EMs are in fact less at risk of tightening, and really those that are less at risk are largely the EM Asia markets, which makes up the majority of the index. Once again, telling us that the risk itself should be rather manageable for the year at least. Yeah, so moving on from the macro fundamental to the corporate fundamental. So we take a look at the EPS recovery for emerging markets, and one of the key catalysts for EM equities this year, as I believe, is the cyclical EPS recovery. So we do expect quite a strong and healthy EPS recovery for emerging market this year. And to kind of gauge the health of the EM EPS recovery, we look at various indicators. So things starting off right here on the chart here, we can see the EM EPS sentiment versus the next 12-month forward EPS. So EPS sentiment is generally defined as the number of analysts upgrade minus the number of analysts downgrade, divided or scaled by the total number of upgrades and downgrades. So it gives us a sense of, is analysts themselves right now being positive on EPS or negative on EPS as defined by the number of upgrades or downgrades. So what we see here is, in general, EPS has seen strong upgrades year to date, about 5 to 6%. So with the positive, the analyst sentiment still in play, and that itself is implying that perhaps more EPS upgrades can come in the next couple of months. So as we observe from the chart right here, EPS sentiments, because it is a sentiment measure, it tends to lead the actual forward EPS by about 1 to 2 months. So again, it is showing quite clearly that there is still some room to go despite signs of a near-term peak. So if you look at the commodities prices themselves, they are also telling us the same story. So commodity prices on a year-on-year basis tends to lead the EM's next 12-month forward EPS by about 3 months. And given the strong performance of the commodities market lately, we see sort of a divergence in strength for both of this index. So that is being captured here on the screen on the chart right here, whereby we see the commodity prices shooting above what we've seen over the past 15 years. So I think that is sending out a pretty strong signal that given the lagged effect, the EM's forward EPS stands a fair chance to go even higher over the next couple of months. And again, looking at macro indicators themselves, they're also telling us the same picture. So on the chart on the left-hand side, we take a look at the City Economic Surprise Index. So that index itself measures whether how much economic data has surprised positively within the emerging markets space, and as well as how much has surprised negatively. And so if you look at the gray as well as the green line right there, we'll find that, in fact, economic data has been beating expectation largely for the better part of the year, and this itself can be leading the forward EPS, and in fact, it leads the forward EPS by about 3 months. So I think that itself again is pointing to further growth in EM EPS for this year. So the same can be said for the Asia export. So I think Asia export is one of the telling indicators here for emerging markets growth as well as EPS. So if to look at both the Asia export leading indicators, which is the Nomura Asia Export Leading Index, plot against the forward EPS, we find that it tends to lead that EPS by about 2 months. And again, Asia exports has been relatively strong, and it shows no sign of a peaking or dying. So I think that itself is showing a possible upwards revision or even possible growth for EM EPS moving forward. And lastly, right here shows the China credit impulse, which is the major driver for EM equity as a whole. So we can find that the China credit impulse actually moves in wave. So what we've seen lately is the peaking of China credit impulse, no doubt. But this is significant for EM equities, like I mentioned, in a lot of ways. But I think more importantly, for emerging markets, EPS, it tends to follow the trend of China's credit impulse rather closely. But what we've seen lately is, despite the pink, this credit impulse tends to lead the EM EPS by a good 1.5 years. So I think that itself is also telling us that there could be more room for EPS to go, despite the fact that it decided to pink, and telling us that EM EPS may pick up in the next couple of months. We do still believe that there could be positive growth even the EPS has picked. So I think that itself should take us to positive EPS growth for much of this year as compared to the dramatic performance seen last year. So that itself is a good sign in the overall engaging the overall health of the EPS recovery. So to sum things up for what the couple of slides that we've gone through, some of these indicators that helps us gauge EPS recovery, overall, there are a couple of them that are peaking, but it's not really a concern for us right now, because even if it peaks, we do believe in that EM EPS should continue to be positive for the much of this year, or if not the whole of this year. So with that said, we are still constructive on the EPS recovery for emerging markets, and to have to understand a little bit more closer on how the EPS cycle in emerging market works itself. Let us take a look at the historical data for the trailing 12-month as well as the next 12-month forward EPS. So as shown from the slide right here, over the past 3 cycle, which is the 2008, 2016, and 2020, we find that the length and magnitude of the recovery for 08 and 16 tends to be longer as it is spread much more wider, and the magnitude itself very much differs from what we have seen lately. So I think the outcome from what I've gathered this chart is that the current EPS recovery is it's a lot faster than what we've seen in 2008 and 2016. But overall, we think that there's still room to go, and a key part of the reason is the dramatic fall in EPS that we've seen over last year. And given that much of this recovery is quite front-loaded, we still believe that there could be some room for EPS to go based on history before it actually picks down. So overall, when we look ahead, we find that the EM recovery, the earnings recovery itself is well underway. We believe that the EPS growth in this year and next year will still remain robust on both an absolute as well as a relative basis. And we are expecting strong double-digit growth for the year. And this is important because it will be a supportive or strong reason that is supportive of EM performance, especially on this relative basis, because in across history, whenever we see outperformance for EM EPS versus DM, we like to see a rotation from DM into the emerging markets and giving them a boost. So I think that similar to growth outperformance, the EPS outperformance is also a key reason, also integral for the EM DM outperformance. And therefore, I think based on the chart right here, you can see why we are still constructive on EM EPS outlook. So moving on to valuation itself, I think valuation for EMs may be a bit challenging, at least for using a 2021 EPS estimates. But to us, it's not really a concern right now because of 3 key reasons. So firstly, I think if you look across most emerging markets, we believe they are trading at a premium. So it's like shopping on an expensive street where all the items you buy are still expensive. So we are trying to find the cheapest item on the most expensive street, which can be a bit challenging for investors. So I think EM itself is one of the cheapest item on the most expensive street. So a key reason for that is also because emerging markets, as we've seen from the chart right here, has traded at a premium of about 9.5% to its historical forward PE over the past 5 years. And a big reason for that is the inclusion of growth stocks, like I mentioned earlier on. And if you look at the average forward PE over the past 5 years, it is about 13.5 times. And that itself, if you were to compare on compare against the current forward PE ratio, you'll find that the valuation premium falls to about 10% from the premium of about 20% versus its historical average. So we think that relative on the basis of just the past 5 years alone, I think the valuation looks much more attractive than when you were to take into account the full history of EM equities. And moving ahead, we still see room for re-rating for EM valuation, and a big part of it falls down to two reasons. First is the next year's PE, as well as the relative valuation versus the developed markets. So on the chart on the left, you can see the PE ratio using this year's EPS as well as next year's EPS estimates. We will find that the valuation differs quite widely, and we do believe that if we were to factor in this year's strong cyclical EPS recovery, we will likely to see a more palatable PE ratio for using next year's EPS estimates, and I think that itself to us makes EM equities much more appealing from a multiple perspective. And with that, we do see room for re-rating, given that with a 2022 EPS is still trading at a discount in our eyes. So I think our next big reason for re-rating will come from the relative valuation perspective. So the chart on the right shows the relative valuation between the EM and the DM. So from the chart right here, we can see that EM historically trades at a 22% discount to developed markets. So what we've seen lately right now is that EMs are trading at a 30% discount to developed markets. So given how much developed markets has shot up, I think that is one of the key reasons why EM is trading so cheap versus developed markets. And we think that this valuation dispersion itself is hitting quite an extreme level, because the extreme level as shown from the chart right here is about 35%. So we are just 5% short of that. And this dispersion itself could trigger more potential for rotation from DM to EM when EM equities gain more traction. I think that is a huge reason why we still see scope for re-rating for emerging markets. So just to sum it up, for a couple of my key points right here, what I believe is that we still maintain a very constructive view on emerging market equities, and we do target an upside of 22% by end of 2023. So a couple of key reasons remain supportive for our thesis. So firstly, we see a robust growth outlook. Like I mentioned earlier on, the growth momentum itself, we believe will strengthen in the second half of the year, and even more so as we close the year out and as EM's vaccination and reopening catches up with developed markets. And also from a corporate fundamental perspective, we see strong double-digit EPS growth for this year as well as the next year, and with more scope for upgrades, like I mentioned earlier. And also on top of that, we see room for valuation re-rating, and that itself could adds up to more re-rating upside seen over the next couple of quarters. And there are also a couple of key reasons why we stay bullish on emerging market equities. I think several reasons I mentioned earlier on in my slide, but to reiterate them again, I mean, these catalysts are your global cyclical recovery, easy monetary condition, commodity prices, which we believe will go up even more, as well as the value and reflation trade. And that itself is important because it benefits emerging market due to its favorable sector mix. And as I shown earlier, EM still has a large proportion of your cyclical as well as your reflation theme sectors, and that itself should benefit and should uplift emerging market equities as we go along the quarter. So I think with that, I've come to my end of my presentation, and I should hand the time back to Jonathan.
Okay, thank you, Colin, for that sharing. We will now move on to Christopher.
Hi, everyone. Good evening to you, and thanks for taking time this evening. So can we just start off with the first slide, please? Now, before we begin, we thought we'd like to share a very quick overview for Fidelity and the unique investment proposition that we bring. Now, we believe there are three factors that set us apart from other asset managers. On the next slide, please. The first, we are privately held. The next one again. Which means that we can afford a long-term view to our business compared to many listed peers that have quarterly shareholder commitments. Now, the second, we are experts in investments. Investments is all that we do in Fidelity. Our research footprint spans across the world with deep coverage across regions, sectors, and asset classes. And third and most important, the client is at the center of our business and drives the creation of the services that we provide. We look to partner with our clients for the long term. And as we are not part of any larger bank, insurance, or brokerage group, our objectives are aligned with our clients. And our track record since 1969 would be a testament to our quality. And on the next slide, what we believe differentiates us the most is research. Now, we have one of the largest buy-side research networks in the asset management industry, with 400 professionals, half of which are dedicated to research in 16 locations. We cover 80% of the world's market cap and global investment-grade credit bonds at any point in time. Between them, we conduct more than 16,000 company meetings each year, which put differently translate to a meeting every 10 minutes on any working day. Now, you may see the photo before you. It is something that we're quite particularly proud of. So we were one of the first investors in Alibaba about 19 years ago. And our tech analyst there, Daniel Albert, circled in red, is pictured beside a certain Mr. Jack Ma at the IPO then. And of course, the rest is history. Now, on the next slide, and this has paid off, judging by the number of awards that we have won over the year. Now, on the next slide, before we begin our session proper, next slide, please, we'd like to ask everyone a quick question. Can you run the poll, please? So how much of emerging market equities does Asia make up? A, 10%, B, 40%, C, 50%, and D, 70%. Okay, I believe everyone would have an idea in mind and input your answer. Can we bring up the results, please? Yeah, very mixed crowd here. So majority thinks it's 70%. Second up would be 50%, and 40% the third, and a very small minority with 10%. So can we just close the poll and bring to the next one? And if your answer is 70%, next slide, please, you are correct. D. So Asia forms a dominant part of the emerging market sphere, and the top 4 markets in the MSCI Emerging Market Index as a proxy for the market are Asian markets that make up 60 to 70% of the index. And you guessed it, the top 4 are China, Taiwan, Korea, and India. Now, on the next slide, what do we expect going forward? Now, following a very challenging 2020 for everyone really in this call and for markets as a whole, we are cautiously more optimistic on the outlook for 2021, given recent positive developments. So on the virus and vaccine, so more than 1 billion vaccine doses have been administered worldwide and continues to increase. This gives hope for some further reopening of the global economy in the second half of the year. A unified government in the US will also make decision-making easier for the largest country in the world. Recent economic data on average has been strong, which is a positive. And all this amidst a very supportive monetary and fiscal backdrop globally. And with that, we see a few broad themes emerging, amongst which Asia is likely to take the leadership during the course of the recovery out of the crisis. And there will be select opportunities in emerging markets. So on the next slide, from a global business cycle perspective, manufacturing remains strong as order continues to grow and backlog starts to clear. Service sector is also getting a pickup, and this is where we think the next boost to growth will come from globally as excess capacity starts to get utilized. And on the next slide, and from the ground, in our most recent annual Fidelity Analyst Survey, which we poll our analysts that really visit the companies and do the research, that'll be the next slide, please. Our analysts found that most part of the world are still in initial recovery stage. And in this stage of the cycle, emerging markets tend to do pretty well. And on the next slide, and these global cyclical developments are also flowing through the company earnings. Now, based on our analyst estimates as they speak to the companies, earnings on Asian companies are expected to do well this year after strong resilience last year. So they'll take up from your chart, you'll see the second row there, right? It had a slightly less shallow, it had a more shallow dip last year, earnings-wise, but this year is looking to grow at a comfortable rate. And EMEA and LATAM regions are expected to experience a strong rebound this year. So they will stand at the second last row in the chart before you. And why? It's because of the large drop in earnings last year and because of the more cyclical nature of these markets, which tend to be a bit more levered to an improving global economy. On the next slide, virus and the vaccine. Now, on the vaccine front, we are seeing pretty good progress in emerging markets. The chart before you show percentages of each population, countries or regions' populations that have received at least one vaccine dose. We are seeing strong vaccine progress in CEMEA, right, and LATAM regions. Although progress is still quite uneven among some of these countries, the direction of travel is still a positive one. And on the next slide, all this happening amidst a monetary policy backdrop that is very supportive, monetary and fiscal actually, including that in emerging markets. And if growth for any reason starts to wobble, we think relatively strong fiscal and monetary fundamental positions, many of these countries still have room for more stimulus. So for example, in the chart before you, the two charts illustrate current interest rate levels of Asian countries and debt levels against developed countries. So general interest rate levels in Asian countries are much higher than that in developed countries. You see on the left, and there's still a bit of room to cut interest rates if really necessary, if growth starts to sputter a little bit. And on the right side, on the fiscal front, debt levels are much healthier than in developed countries as well. Hence, Asian governments also have room to implement fiscal measures to stimulate the economies if necessary. Now, on the next slide, emerging markets are also pretty uniquely positioned based on their market structures to participate in both a short-term recovery and long-term structural growth. So on one hand, you have the LATAM EMEA regions that have largest exposures to reopening trades globally. So they have larger exposures to financials, commodities, and other cyclical sectors, making up between 60 to 75% of the equity markets. And on the other hand, also boxed up on the right, emerging Asia has more exposure to structural growth. So yes, larger exposure to IT, healthcare, and other kind of consumer sectors on top of other defensive sectors like utilities, for example. And on the next slide, this really takes us to the core investment case for emerging markets at this juncture. So the first, emerging markets remains an attractive long-term story, supported by demographics, and one can get this exposure at attractive levels, valuations. The second, emerging markets, you get exposure to structural growth of Asia and to many global industry leaders in their respective fields. And the third, emerging markets are evolving. So other than cyclical sectors, you do get rising exposure to companies participating in longer term trends like innovation, consumption, financial services penetrations, just to name a few. Now on the next slide, first, just a recap of long-term performance. So emerging markets and Asian markets have done well over the long term since the start of the 2000s, as denoted by the orange and the brown lines in the chart before you, doing better than global and US markets. And there are reasons for this to continue over the long term, and we will discuss why. On the next slide, at the core of this long-term thesis is emerging markets. The next slide, please. It's its growing population and the contribution to global GDP. Now, as shown by the chart on the left, emerging markets have grown from under 40% of GDP in the 90s and is projected to grow to over 60% in this decade. And this could potentially be accelerated by the COVID crisis. So, for example, recently certain think tanks are now expecting China to overtake the United States to become the world's biggest economy by 2028, 5 years earlier than previously estimated. So that's an example. And on the right side, consumption in emerging markets will likely grow with this. It is estimated that it will take up almost half of global consumption this decade from just over 30% in 2010, a decade ago, almost. And on the next slide, the rise of the middle class is another exciting long-term story and driver of long-term growth in emerging markets. The middle class in emerging markets is expected to grow exponentially, led by China and India, and will potentially outstrip that of the developed world. And emerging markets are consumers, are expected to account for more than 50% of global consumer spending by 2030, from a very low base. If you look on the left side of the chart on the right, from a very low base in the 90s or the early 2000s. And on the next slide, amidst all of this, valuations are still at attractive levels. So just using traditional valuation measures like PE at this juncture, emerging markets and Asian equities are trading at cheaper levels compared to their global and US peers. And on the next slide, as we discussed a little bit earlier, Asia is a predominant driver of emerging markets, or rather, it's a big part of it, where there are many structural trends that are taking place and many very good high quality companies. And Asia makes up about 70% of emerging markets at this point in time. And on the next slide, beyond participating in the growth of Asia, emerging markets really is home to many global industry leaders. And one can get exposure to many solid, good quality companies that are leaders in their countries, regions, or even globally. Let me highlight a few to you. For example, China is home to Alibaba, the world's largest retailer and e-commerce company, and one who runs some of the largest online market spaces in the world. Taiwan has TSMC, the world's largest independent semiconductor foundry and an indispensable part of the global semiconductor value chain. Hong Kong is home to AIA, the biggest life insurer in the world and continually growing its presence in the region and in China especially. Beyond Asia, we have a tech conglomerate in South Africa, Naspers. It offers internet and media services and is a key shareholder of investments in Tencent and other tech platforms. For example, it owns an online education platform called Udemy. In the commodity space, Brazil is home to Petrobras, one of the largest producers of oil globally. Really, this is just a subset of the many exciting examples available for long-term emerging market investors. And on the next slide, like what Colin mentioned a bit earlier, we have seen an evolution on the market in recent times. So exposure to cyclical sectors, you see on the left side of the chart before you, have reduced, and exposure to structural sectors that are benefiting from structural growth like consumer discretionary, IT, communications have increased. So you see that in the other three bars before you that are highlighted. And this for good reason, because of the many growing structural trends. Over the long term, this will also help to make earnings of the market more sustainable and potentially also command a higher premium valuation as a whole. Now, on the next slide, here are a few examples why we think this evolution will continue over time. So internet penetration, for example, is one example. Penetration in many emerging markets, especially in the EMEA regions, exhibit low online penetration rates, offering ample growth potential. For example, in Russia, the share of online versus total retail sales stands at only 6%, having already doubled over the past 5 years. Or in the GCC, the Gulf regions, online penetration is also low. So for example, in the UAE, it stands at about 3%, in Saudi Arabia, lower at 2%. Now, these figures, like many developed markets you see on the right side of the chart, and even China, the world's largest adopter of technology. Importantly, these countries are ripe for structural shift. Why? Because of improvements in internet infrastructure, growing adoption of high-speed mobile internet in rural areas, access to affordable data, as you can see by the kind of data charges for emerging markets and developed markets in the sub chart you see before you, and large, young, and digitally more savvy population. All of this, we believe, provides an opportunity for increased penetration in the years to come. And on the next slide, another example would be financial penetration, which remains low. So the chart on the left shows penetration of mortgage is low in emerging areas, for example, like India, Thailand, or Malaysia, well below that of developed markets. On the right, insurance penetration remains low as well, compared again to developed markets. So giving rising affluence, rising asset holdings, and financial sophistication, we believe there is room for more penetration over time. And on the next slide, a common misconception is really that emerging markets is all about China internet and commodities. Now, while they are still sizable parts of the market, there are many other trends and opportunities out there. For example, there are higher growth companies leading tech changes and capturing domestic market shares from internet peers. One example I can quote is in Russia. We found a company called Headhunter, an online job portal with a market share of more than 70% versus 3% captured by LinkedIn, a more international brand owned by Microsoft. And Headhunter is benefiting from the ongoing economic recovery in the country. To participate in growth of financial services, we are uncovering opportunities, one of which is AIA, we discussed a couple of minutes ago. In emerging markets, there are also defensive ways which we can diversify kind of exposure in our portfolios. So there are gold miners which, because of their close relationship to gold, provide a hedge against inflationary pressures and volatility. So an opportunity that we are finding in our portfolios is the DRD Gold in South Africa, which is a world leader in gold production from tailings retreatment. And another way really that we're finding to capture growth in consumer spending growth would be investing direct into other than investing direct into Asia-based consumer companies. We are also finding global opportunities that give an indirect exposure. An example would be an extreme right Adidas, which has a good foothold in Russia, Asia, and Latam, regions benefiting from long-term structural growth in consumerism. And Adidas generates nearly 50% of their revenue from these regions. And lastly, there are still risks and developments out there that we should be mindful of. So things that we are keeping a mindful watch of are, for example, the virus, whether we can eventually manage to get this fully under control, or whether there might be future mutations out there that might kind of derail what's happening now. Monetary policy, that has been very accommodative, and the central banks largely have been very committed to continue doing so. Their policies in the coming months and quarters would definitely have an impact on emerging markets. Fiscal policies, will that help to support global growth, and will we still see even more supportive policies going forward? Politics, how would that affect the global economy, markets, and the landscape? Hence, with some of these events still in the backdrop, we find opportunities in emerging markets. However, we advise investors still be selective and have a long horizon when doing so. So really, with that, I thank you for your time, and I'll be happy to take on any questions you might have in the Q&A segment. Thank you.
Right. Thank you, Christopher. And with that, we've come to the end of tonight's session. I would like to thank our audience who have stayed with us and paid attention so attentively all throughout. I'd like to also extend a special thanks to Christopher for coming on and to share with us more about Fidelity's strategy and the approach in emerging markets. Yeah, for those of us perhaps who have members of the audience who have not seen the link to FSM's recommended fund for the global emerging markets, just stay online for a few more moments and we will paste the link when you can go have a look at the fund fact sheet. So once again, thanks to Colin and to Christopher and Fidelity for coming on and sharing with us tonight. To our audience, thank you and stay safe.